Hello there, this is Michael from Forex Training Group, and today we're going to discuss price action trading guide for Forex traders. Price action trading in Forex is basically a method or a trading method based only on analyzing previous price behavior. What traders do is that they are looking back in time and look for patterns like candlesticks or support and resistance levels and trying to forecast those levels on the right side to find good entry or exit places for the trades. This means that a trader again analyzes market on a naked chart without any indicator or oscillator, so no RSI, no CCI, no nothing but pure simple candles. The most important process in price action is identifying ongoing trades. You should always try to trade in the direction of a trend. There is a saying also that the trend is your friend. Now this is not something that you want to fade. Price consolidation appears when price is ranging without a direction, without a clear direction. Usually the Asian session is full of ranges, full of consolidations, as the biggest financial centers are still London and New York. So London session will be much more animated as well as the North American one rather than the Asian one. A good trading rule would be to stay out of the market when price is consolidating. So trading in the Asian session, the FX market, is a bit tricky. Traders use support and resistance levels as well to set entry and exit points on their trading position when trading with price action. Now this is important because the support and the resistance level, it is transforming in the sense that by the time the support is being broken, it becomes resistance, and by the time resistance is being broken, it becomes support. Every Forex trading strategy can benefit from support and resist, or from proper identification of support and resistance levels. Let's take this one for example. This is US dollar and Japanese yen on the daily chart. So what do we have here? We have a move to the downside, as we can see in here, that hits our support area, this yellow line, the support area, and it is in doing that we have a red candle with a huge shadow and a small body. This one is being called a hammer. Now this hammer is a bullish reversal pattern, so staying on the long side in here is not advisable. And then we see that market tries to break high and fails 1 time, 2 times, 3 times, and then rejected all the way to the downside. In forming this attempt to break the resistance, basically it forms a bearish reversal pattern. This one is being called an evening star. We have a huge red candle, a huge green candle, a small red one, and then another red candle to the downside. It comes into our support, so in here we are not interested to be short anymore. Moreover, we see a huge red candle, then a doji, followed by this green candle. This is being called the morning star, another bullish pattern. So resistance holds again and then comes into support again, forms a possible double bottom, is being called, goes to the so-called neckline of the double bottom and forms, take a look in here, forms testing 1 time, 2 times a double top, and then approaches and breaks the double top. Well, by the time this break is coming, then we can say that the resistance area is being broken. How about the breakouts? One of the most common ways to trade key levels is simply trying to go with the market flow, basically when the range is being broken or when support or resistance level is being exceeded. Trend lines are really important when it comes to trading, not only when it comes to trading FX market, but when it comes to trading in generally, as they act the same way as a horizontal support and resistance. The difference is that a trend line can be also diagonal. This is being called dynamic support and resistance, in the sense that you will have a resistance every time price comes and hits this trend line. It will be resistance, 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 only that the resistance level is not on the horizontal like it was on the previous example, but it is actually on a declining downward trend. Channels are also important, as they act in a way, in the same way like the trend line, with the difference that these channels have another level which forms a corridor with the trend. This is a channel on the US dollar and Japanese yen on the 4-hour chart. Now take a look here. We have resistance to the upside, support, resistance, support, dynamic again, dynamic support. Resistance broken, or the channel is broken, forms here some kind of a pennant or a continuation pattern, and then the new trend resumes. Very important is to use candlestick patterns like we used on the previous example with the horizontal support and resistance level, as this is a very common technique for price action traders. This is also a good example in the sense that this Euro-US dollar 4-hour chart comes after a bearish trend, forms a huge red candle, then a hammer candle, and a huge green candle. This one is being called a morning star that has the hammer in the middle of the pattern. It is not bullish, it is extremely bullish. So staying short here is not advisable. So you don't need any indicators or something, but only watching classical old price action. These chart patterns are specific formations and figures on the chart that gives clues for trend continuations or reversals. In our case, in the previous example, it was a reversal. Sometimes a pattern forms a measure move, like it was with the double top or the double bottom. Measure move will be the minimum distance that the market needs to travel, but careful with these measure moves. It doesn't mean that market should stop there. In this example, we have the Great Pound US dollar on the 4-hour chart forming a head and shoulder, with this being the neckline, and normally the measure move or the target is the same distance from the head until the neckline. Thank you for being here and have a great day.